we saw a one-day shocker with mid-caps selling off. Of course, they've recovered since, and the market continues to make new highs and show momentum. But what to expect going forward, where to look for opportunities, what to be wary of, and much more. I have a special guest, Samit Vartak from SageOne's investment manager. Samit, thank you so much. This is the first time you're going to be on Moneycontrol with me. Thank you so much for taking the time out.
No, it's absolutely a pleasure. I remember, I was first on Moneycontrol, I think 6 years, 6 years back. So
Right.
really, really good to be back on it.
Sure. So Samit, mid-cap, small caps is really your hunting ground. It's your mainstay. For most fund managers is one addition to their portfolio, but for you, it's mainstay. So how do you look at this space now? And especially large, the sell-off that we saw on one day last week, how do you read into that?
Right. So I think there are two aspects to the sort of looking at it. So one aspect is obviously valuation, which is generally the main focus of discussion in amongst investors, amongst social media, and there is no question that valuations are stretched. But that's just sort of one part of the puzzle. The bigger part is how are we positioned for earnings growth. I think that's where sometimes in the short term you end up missing sort of the forest for the trees. I think that's where I'm extremely positive. If you look at say last 8 years or 9 years of the Modi government, 2014 to now, most of the time the valuations have been mostly expensive. Other than maybe a couple of years, that 2019 and 2020, when COVID happened, and then there was a small and mid cap sort of crash which happened in 2000 and sort of late 2018 and 2019. But beyond those two sort of years, most of the time the valuations have always been high, right? And I think the earnings growth has been pretty slow over the last 8 years. If I just look at the last sort of 9 years, the average or the CAGR over that period has been barely 10%. It's mostly in single digits. It's between 9 and 10%, right? And but I think the biggest change has been how has been the cash flow growth. The cash flow from operation growth over those 9 years has been about 16%, almost double of what the earnings growth has been. I think that's been one of the big changes, is what has happened to the balance sheet and then the cash flow. So the balance sheet, if you look at, I've been speaking about this for a long time. The balance sheet is probably the best that you have seen, not only at the overall level, but especially in the small and mid cap space. So the debt to equity ratio, if you net off the cash that's on the balance sheet, it's probably close to 0.1 or 0.15 times, which at least I have never seen in the last 15 years, or even before that. I mean, even if you analyze things before that, you will never see that kind of a ratio. The ROE, ROCE of the small cap space today is as good as what the large cap is. Historically, it's been at least 3 to 4% gap. Small caps ROEs used to be around 12 to 13%, whereas larger caps were closer to 17% or 17 to 18%. Today, the large caps are there, around 17%, but the small caps have caught up almost, crossing 16%. So those are the big changes which have happened. And out of those last 8, 9 years, the initial 6, 7 years were just spent in cleaning up the system. There were a lot of reforms which were implemented, big budget reforms which were implemented. We all know about those reforms, whether it's from the GST, the tax cuts, and many at the industry level, a lot of reforms in terms of incentives, like the PLI schemes, labor reforms. All of those do take time to to show results on ground. And I think because of that, the earnings, there was slowdown in earnings, and plus we were hit by COVID, so it also, took away a lot of momentum. But there has been huge capex which has happened from the government side. Even if you look at the growth in gross block, which is just pre the COVID, 3-4 year average were almost 16%, so which is pretty high. During COVID, it did slow down. So I think when I look at this small cap space and look at the fundamentals, they look exceedingly good, better than what I've seen before. And valuation is a concern, and valuation is the reason I think we would get in short term these shockers like what we have, what happened last week, like a 4% kind of a correction. I mean, to get valuation correction is always good to have 10-15% kind of sort of cool down in the market. It helps for the market to at least clean out the excesses. There are a lot of with good, lot of bad also flies in these kind of markets, and that's what's happening even today. So I think it's good to clean up. One day is not, I guess, enough, but I think 10-15% kind of a correction would definitely be a welcome step.
Sure. Samit, this is really useful. You sort of laid out for us the fundamental picture, which often is missed. And I agree with you. This, in terms of both balance sheet and P&L, today the mid cap, small cap space is showing a lot more strength than we've seen in the past. Can you tell us what is the underlying force that has really resulted in this change? And I'm asking this because that is what should give us the confidence that whether this change will be carried forward, or is it some 1 year to 2 year rebound post COVID that will wear off in some time. What do you think are the underlying factors that have changed the complexion of the mid cap small cap space?
Sure. So I think a couple of things. One definitely is the source of money. I think, before these years, getting project finance was much easier. With there was some not so good practices followed, and you could get if you need 100 million worth of real project finance money, you could get significantly higher amount of that by probably playing the system, which has been taken away. So that easy money which was going into companies isn't happening now, right? It's especially for sort of large projects. Secondly is before COVID, and this is more recent. So before COVID, a lot of companies were always hesitant, to reduce sort of their payment terms. So for example, a lot of building material companies, they always gave sometimes 30 days to 60 days sort of credit period to the distributors, right? But when COVID hit, things got so desperate that people were just trying to survive out of that, and they just wanted to protect whatever cash they had, right? So that definitely forced them to reduce. So I know so many building material companies who said that we will not supply any new material unless the previous cash is paid off. And that happened across many industries, and just that fear, and that helped post COVID. In the next couple of quarters, there was, I think, the highest amount of cash collection that the companies did. So it was sort of an experiment which never they dared to do, and it succeeded. So I guess these two changes, and once you see the benefit out of that, then you don't want to generally go back. And I'm happy. I thought that maybe in few quarters, the companies will probably go back to their normal. Some companies will then try to extend higher credit term, and then things will just fall off. But it hasn't happened. It's been more than 2 years, almost now 3 years, and companies have been very disciplined. And that is the reason I think the ROE, ROCs are high. And it's not just supported by the P&L profits, but the cash flow profits. And that's where the cash flow from operation growth has been significantly higher, than just the PAT growth. And another metric is, CFO to PAT. That ratio also has improved significantly. It's, from the lows, it has almost doubled. So those things I feel, if they're sustained for 3 years, it's sort of getting into the culture of companies, and hopefully it will last.
So two very important points you're talking about. One is the efficiency of companies in terms of you said gross block, more efficiency at the project level, which is throwing up better ROE. So I want to spend 1 minute on that because this is a very unique and important point. And the second is, should we say in some sense, all these companies have displayed anti-fragility in Taleb's terms. So you go through stress and you actually come out better after the stress. You permanently reduce costs. So first of all, in terms of operating costs, the way the structure has changed, do you think that is permanent? Because some part of the cost, for example, world over now, there is a rethink on work from home. Everybody is already in hybrid mode. Is there possibility of, some cost escalation as we go into a normal world? So how much of that cost out is really, do you expect will come back? And second, is more profound, the fact that ROEs are increasing, and perhaps this is not true only for smaller companies, it might be true for larger companies also. Is this because of any fundamental change in our credit dispersal system, because banks are probably more wary of the kind of credit that they are writing today? Is that playing into it, which is a more long-term profound change, if at all it is?
It is exactly, I'll cover the last point first. That exactly is the first reason I said is that, 7-8 years back, I mean, that's the reason we had the huge banking crisis, which actually ended up resulting in 2017, 18, 19 banking crisis. But, that gross non-performing assets were just building up. And that was, I think, the core reason for that was the poor lending practices, is that there were I knew so many of these middlemen, who were creating project reports. Like for a capex of 100 crores, they will create a project report of 150, and the company will end up getting 150 crores when actual capex which the company would do was 100 crores. And then the 50 crore, some part will go to the officer. So I mean, those kind of sort of corrupt practices definitely have significantly reduced. And that's where the easy money which companies used to get is I think is history, and I don't think it's going to come back. And that's where the companies have become much more frugal now. And if you see the recent overall, if you look at the recent capexes that the companies have announced, majority of that is happening through internal accruals. Because a lot of companies who are doing the capex, they have reasonably good ROE, ROCE, closer to 20%. And if you make that kind of money, generally that should be good enough to create a growth of, growth through capex or growing through your expanding capacity by 18 to 20%. So that so taking leverage is really not required. And that's what I'm seeing across many companies, even after going through doubling of their capex or tripling of their capex over a 3 to 5 year period, their debt to equity actually has gone down. And as you become more frugal in utilizing the money, of course your ROE and ROC are is going to go up. It's not just because of sort of temporary reduction in costs that they have seen. It's just the management's attitude completely has changed, because they value the money, and even the markets have starting valuing such companies very differently than companies who are sort of loose in their capex plans. So I think any company which has sort of better return on incremental investments, does get way better valuation than companies whose incremental return on capital is way poorer than what their existing return on capital is. So that's one of the metric even we have been using, but I think more and more investors are realizing the benefit of that, because it's not just the profit and the growth that one should look at. It also, you need to look at how the balance sheet, whether it's improving, and your growth, whether it's value accretive or is it value destructive. A lot of growth which happened, say, in 2005, 6, 7, 8 was value destructive. You get to know about that it was destructive much later, once the results of that on the banking system, on the company profitability, on how money, especially working capital was, stretching. Today, working capital is, so that's a big difference. Working capital cycle is actually decreasing. The ROE, ROCs are improving. The gross NPAs at the banking system are probably the lowest ever in India's history. So these are the core changes one has to look. Unfortunately, most of the investors are just focusing on the valuation and completely missing the forest, for the trees.
Sure. So Samit, this is something that we often hear from most experts, but the limitation is that we are unable to talk stock specifically with a lot of fund managers, and the message is really lost when you are not able to demonstrate with live examples. But keeping that limitation in mind, can you lay out for us how do you really differentiate between the good and bad? Are there some quantitative factors that retail investors who perhaps let us assume that they don't have any access to management, which they don't have except for, let's say, a con call transcript or something like that, and the financial numbers that are published with just these resources? Can you lay out a framework that should be able to help us from segregating the good and bad?
Sure. Yeah, I mean, yes, it is a pretty comprehensive topic, which I'll try to see, if I can give maybe some pointers towards. So one of the things that I think in a good market, in a good economy, many companies do exceedingly well. At that time, margins expand, profit growth grows through the roof, ROE, ROCs do really well. So if you're analyzing any company, within that industry, just I think segregate the ones where during bad times, their margin profile and ROE, ROC profile really deteriorates. Focus on the ones who are really good or, relatively much better during the bad times. So you can't just evaluate a company based on sort of today's profitability. You have to look at how they did during the down cycles. So that one thing is very important. Secondly is completely, cash flow. Cash flow is the king. And beyond, I know a lot of people do like focusing on free cash flow. Cash flow is also important, but in a high growth company or a high sort of growth economy, you will not see too much of free cash flow because a lot of that does get reinvested back. So look at maybe cash flow from operation, because that is independent of the investment. How much is the cash flow from operation compared to the net profits? You don't want that cash flow from operation to be sort of getting inferior or reducing. At the same time, the net profit on the P&L side improving. So the growth in cash flow from operation is more important than sort of the growth in the net profit, because unfortunately, again, net profit is the focus area for most investors, and the balance sheet is not. Thirdly, I would say look at, especially in good economy, when everyone is going for capex, there is a lot of money flowing into companies, a lot of IPOs. So there is easy availability of money, at least from the equity markets. Look at increment. So whatever is the new capex they are going for, or maybe the recent capex that they have done, look at what's been the return on equity or return on capital on that just incremental, part. And I generally try to look for it that, it at least has to be about 20%, because most of the if the average itself is at 16, 17, 18%, you want at least somewhat superior profitability company. So at least that should be better than 20%. But also it has to be at least as good as their existing ROE and ROC. You don't want a company which is generating 35% ROE, ROC, going for a project which is 20% ROE, ROC, right? If there is a company which is at, say, 16, 17, and they're going for 20% is good enough, but sometimes companies go for growth just for sake of it, just to show the market or show the investors that it may not be the prudent decision for the company, but it is based on sort of the pressure that investors put on the company, that they go for growth, and that growth is actually value destructing, especially if their ROI on that investment is subpar. So those are the few things that I would look for. Beyond, I mean, there are a lot of other things that you can always look for in terms of looking at the credits, how much are they growing business by loosening their sort of credit terms. A lot of those things will come up in your working capital days, right? So you don't want the working capital days to be ballooning as they are growing, because that itself will have an impact on their CFO, cash flow from operation. But those things are very important that you are aware of them, and that is at least beyond just looking at the EPS growth and then the PNL growth and just the PNL side. Yeah.
Sure. And let's come to valuations now. This is something everybody understands because everybody looks at P and then says that this is expensive and this is cheap. Now, do you think mid-caps really do deserve higher valuations? Because the idea of higher valuation would be justified if they were to promise higher growth.
Right.
But then along with growth also comes fragility. So how do you, from your lens, what is the threshold you keep for valuations for mid-cap versus, if you were to benchmark against a Nifty?
Right. No, I mean, see, so now again, there are so many different kinds of definitions for mid-cap. So now, based on SEBI, top 100s are the 100 the large caps, the next 150 are the mid-caps, and then the next whatever 1,000 companies are the small caps. Right now, mid-cap and large cap, there's not too much of a difference, because the mid-cap companies themselves are from 15,000 crores market cap to 50,000 crores market cap. So those are also pretty decently sized companies, and hence mid-cap and large caps are equally valued. I mean, if you look at the valuation of mid-cap and large caps, they have been almost the same over the last, at least 3-4 years, and except those, 18, 19, 20 period, even before that. And small caps are even now trading at a discount. And I don't look at, see, it's always sort of difficult to just look at the index valuation. I like to look at the median valuation of top 100 companies, median valuation of the next 150 companies, and the median valuation of the small cap index. It will give you a very different picture, because Nifty 50 valuation is going to be driven by a lot of energy companies, some infra companies, and then you'll get a weighted average, which will look low. But if you look at the median valuation, it will look very differently. So for example, you would say that Nifty valuation, maybe trailing valuation is, I don't know, I mean, I don't know the exact number, but probably say 23, 24. But if you look at the median valuation of the top 100 stocks, today it's at almost 30, 32 times, right? So which is very different than what you would see. If you look at the median valuation of mid-cap, it's at 33, 34 times, which is higher. And if you look at the median valuation of the small caps, for me, small caps are just the 500 companies from 250 to 750. The small cap median valuation is around 27 times. And so they are definitely at 20% discount, but compared to their own historical averages, all these three universes are trading at 15 to 20% higher valuation than just the last 9 years valuation.
Right.
And last 9-year valuations have been much higher than the previous, say, even 15 years valuation. So if you compare it with last 25-year valuation, they are going to be probably 30%, 40% higher valuation. But I don't know whether it's an apples to apples comparison. I would say compared to this sort of Modi era, the valuations even now are 15-20% higher.
Okay. And if you just look at, mid-caps segment-wise, I mean, you have a bunch of cement companies, IT companies. In FMCG, you have lots of companies, foods companies, which have been a favorite in the last few months. Where is your conviction the highest in terms of growth continuing to be strong? Sorry, let me just rephrase.
Mhm.
Where the market is underappreciating growth, but you think the growth is sustainable, and therefore you're more in, you would bat for those stocks.
Yeah, and you're asking this for the large cap space or the mid cap?
Mid caps.
Space. See, I would like to put things into sort of three categories, just to set up sort of the context, right? One category where the growth is high and the valuations are also high. So mainly most of the markets know about that growth. Secondly, there is deep value, that there is growth very high, and the valuations are extremely attractive, right? And the third pocket is where things are bad on ground. Currently, they're going through sort of a bad cycle, bad demand side, and the valuations are cheap because of what's on ground currently. So today, if you see, majority of the companies fall in the first category, which is people expectation of growth is already high, and again, according to the valuations are high. You'll find very little in the second category where growth is high or expectation of growth is high, and then it's extremely sort of cheap, right? And third category, I think there is reasonable options available. So to me today, I think one needs to look at the third category, is that there is temporary sort of you need to look at contra today. That's the only place you're finding value today. And contra plays for me are, some of them are on the export side. So for example, chemical space I feel is in the contra space. If you look at the recent few quarters, their earnings have taken a huge beating. I mean, they have gone down by 25-30%. I'm not saying that even compared to their own historical valuation, they are really, really attractive, but at least their earnings and the margins have been impacted. The most dangerous thing is when you enter at high P multiple and high margins, because there is a double whammy possible, which is the earnings may also just contract suddenly, and at the same time the P multiples also contract. In this case, I feel that there is high possibility that the earnings might expand, not just in terms of sort of top line growth, but also in terms of margin expansion. And plus valuations are reasonable, even though not attractive. So, at least there is one trigger definitely possible. And if the earnings come through, then even the P multiples generally tend to get re-rated. So I would definitely, export oriented is the pocket, whether it's the textile, whether it's the chemical sort of space. Even if you look at pockets like MDF, where last couple of years after China opening up has seen huge sort of, dumping coming into India. And the margins have been impacted significantly. I mean, they've collapsed by almost, one third. So those are the pockets I would look for, if you're looking for value. If you are not, because when you construct a portfolio, you can't just construct it based on sort of just one pocket. A lot of times your sort of, core portfolio may be consistent of the top, where you are extremely confident about the growth, where the earnings growth is pretty high. And if you look at the mid cap and the small cap, the estimated earnings growth over the next 2 years, it's about 20%. It's about 20 to 23% across pretty large base of mid caps. So the estimated growth going forward is pretty high. So it's, sometimes it's not bad to pay 15-20% higher valuation when your expected growth is that high. And I feel that the potential for growth, today seems very high, given the kind of capex the companies have put in, the kind of return on equity that I'm seeing, and plus sort of the opportunity that you probably are getting. I mean, just look at what's happening in China. So the export opportunity definitely is going to happen. It may take a small break, which they have taken, because of the sort of disruption from COVID, right? What happened during COVID was there was sudden buildup of inventory, across global supply chain. Then there was stoppage of supply from China, which in the last 1.5 years, supply from China just came back with a vengeance. The global supply chain was destocking, so overall demand was down, supply was up. Now we are reaching sort of a balanced stage where I think the destocking is over. And whenever there is, the prices are going down, no one wants to stock up, because they think that next one I'll get it cheaper. So why would anyone want to? Now prices have started inching up.
Right.
And when that happens, typically, the stocking up also starts. Right. So I feel that there is probably contra play available there. Growth prospects are pretty good, so you can have majority of your portfolio maybe in the first bucket, which is little higher valuation, because that's the only thing which is available today, but much higher conviction in growth, where if you find companies which are going to double their earnings in the next 3 years or 3.5 years, I feel a lot of them are available today. It's fine paying a little higher valuation of 15-20%, maybe. And whenever the growth comes through, it's very rare that you will see that valuations correct. Most of the time the valuation will keep on going up. So at least, if the growth comes through, you will get the returns which are pretty consistent with the growth rate. And if you can supplement your portfolio, so nothing available in the second bucket, which is great growth available and really really cheap. Well, that only happens in a very crisis kind of a situation, which like COVID or those kind of situations. But the third bucket is where you can find, if you can study the cycles of different industries, not only at the industry level, also at the company level. And then when things are sort of at their worst situation, and you even have a 10, 15, 20% allocation to those kind of themes, it is, you can get re-rating in multiples as well as huge growth, as the industry bounces back. And that itself can create significant alpha in your portfolio. So I would recommend that investor, rather than just focusing on one kind of sort of they focus on the construction of their portfolio, which will have triggers for alpha as well as protect your portfolio.
Sure. So, in terms of contrarian bets, of course, you talked about chemicals and specialty chemicals. Textiles has already run up because there is a lot of conversation around this UK FTA and stuff like that. So, there is some run up that has happened there. So, do you still find that space exciting? And is there any other, contrarian pockets that you still see?
It's not that easy to find contrarian pockets more and more. So other than some, export oriented pockets. So definitely specialty chemicals, some part of pharma. Yes, textile in the recent past has run up, so mostly on the sort of the non-apparel side, which has run up much more. So maybe staying away from that. So again, one has to look at where sort of the excitement is built in. But some pockets, especially on the apparel side, is not that frothy. So one can focus on that wherever the companies have put in a large capex. Balance sheet is really clean, and they have pretty large room for growth, because there has been pretty large destocking which happened even in that space. And you are hitting up sort of into the main shopping season, and you could get surprised. Other areas, I feel even now, some part of building material space, is not expensive. So for example, stainless steel. And one important thing, a caveat, which I always keep on putting on this, is look for not so pure commodity. You look for converters, because they are much resilient, irrespective of the commodity prices, whether it's, like for example, in steel, whether it's at 70 rupees a kilo or 40 rupees a kilo, they will keep on making their EBITDA per ton. They will never go into sort of losses or make super normal profits, based on the global commodity cycle. And such pockets, are available, in their pockets are available in, say, stainless steel. They're available in, in mining side, where, there are clean balance sheets, a profitable company making, probably 30-35% kind of, and available at, 3-4-5 times P multiple. They are available in like even basic chemicals. You look at, the basic chemicals where there are, sort of monopolies in India, one or two players, and they zero debt balance sheet companies with 25% plus return on capital, return on equity, and companies going for expansion. So there is, growth possible. These are not stagnant companies. They're still going for expansion. So a lot of bottoms up opportunities available at this space. Not easy to categorize them into a specific sort of a theme. But even if you run sort of a screener where you look for ROE, ROC of 25% plus and P multiple less than say 15 times, or and then look at the gross block or their announcements of putting up capex. You will find a list of a couple of dozen of companies, and then based on what you like and what you understand, you can pick up a few of those.
Sure. Samit, I wanted your thoughts on sugar stocks, because that is one segment that has not really participated in the rally, but of late it has been in conversation. And usually, if you evaluate these on a ROE ROC basis, they may not even make the cut because it's not secular; it's commodity kind of business. But at this point in time, because looking at the general market and how the market is pricing some of these quality businesses, does this look like a relatively decent opportunity?
Yes, I mean, most of the time, I mean, I have really never invested in the sugar, but from my perspective, I think, is there change on ground that is happening in the sugar space is the key question, because sugar has been a very cyclical sector, depending on the global prices, as well as there are a lot of
political
interference, that the government does keep on. But now, there are talks that the ethanol content, I mean, the minimum requirement for, ethanol to be mixed into the petrol diesel will increase, from say 10% to 20%. And as oil prices keep on going up, the alternatives become much, more attractive. So whether it's the electric vehicle or whether it's an alternative to the fuel itself, right? So if that happens, then it's possible that a cyclical theme can convert into a structural theme, and structural theme can get significant sort of value. But again, you need to probably develop your own conviction. If the market is thinking that it's still cyclical and it turns out to be a structural story, then there is a huge value which is available out there. But really, I'm probably not that knowledgeable about how things will pan out there, but definitely there is a huge possibility.
Sure. Any thoughts on Praj? Because that seems to be, again, it's a very well discovered story. So price wise, you think it's overdone its due?
Yeah, I mean, I can't really speak, and I really haven't looked at Praj in a while. And but a lot of those, whether it's there are a lot of you can qualify as, yeah, they can be called as capital goods companies, but capital goods, when I look at companies like say Praj or Ischeck and a lot of those things which kept me away from those was the return on equity, return on capital profile hasn't been that great. So it's possible if these companies also turn around their profitability metrics significantly, then they can get completely re-rated. And I mean, they did get rated earlier with ethanol, sort of structural story playing out. But for me, my probably style is a little different. I like a little more certainty of growth. I would rather play it through, maybe indirect way, which I'm not really playing the sugar cycle or the ethanol cycle, but like, when I say or when I'm taking advantage of government capex, I'm not going for government kind of companies, right? I would go for companies which are into sort of structural steel tubes, stainless steel, which is utilized in wagons, or electrical cables. I mean, a lot of those themes have become expensive. But if you even hear my interviews, say 6, 7 years back in Moneycontrol, that was the theme that I spoken about at that time, because I could see the on-ground, changes which were happening. And so I don't like that high risk, high return kind of a return profile
Sure.
where it can be great if things play out well, but if they go wrong, they can go horribly wrong.
Sure.
So those kind of bets I do not want to take, and hence a lot of these kind of companies, generally are sort of out of my portfolio.
Sure. Sorry, I wanted to slip in a question, on the contra theme that we talked about. For example, banks, there are a lot of, mid-sized banks. Of course, public sector banks definitely in that lot because, the bottom rung, if you see, or even the middle rung, if you see, maybe trading at, below book even now. Similarly, the power companies, some of the financials, REC, PFCs, Power
Yes.
Grid, many of those, at some time they were trading at like 20%, 25% kind of yields. Today, after the 3 times, 4 times rise, they're probably trading at 7, 8 times yield again. So absolutely, if you see, they've all run up sharply, but the cheap continues to remain cheap. Is that, again, considering the market overall, is that a pocket that you would fish in at all?
Yes, I mean, after a long time, generally we haven't had any exposure to the financial segment, but after a long time, we did take some exposure to the power finance companies because, and then there are a lot of NBFCs which are maybe in that category where the yield, as you said, the dividend yield itself is 7, 8%, and then you would see that their gross NPA profile was improving, the net NPA profile was improving, and then the bucket which was the really troublesome bucket for them, which was the private funding, was contracting, and they were so you could see that the book was improving. If you look at the historical average, the price to book was ranging from 0.5 to as high as 3.5 times, in 2000 and I think 12, 13 kind of a period, and they were trading at 0.6, 0.7 times price to book. So it completely improved uh, book profile, ROE of 20%, and valuation completely attractive. Maybe it did fall into that contra kind of a play. And sometimes when such structural story starts and things keep on improving, the valuation keep on getting re-rated. So you may think that it's gone from say 0.6 times to 1 time. It's already done its bid. I feel sometimes there could be a long runway ahead, especially if their growth continues. Especially given that the government is allowing them to go at least one third of the book into beyond finance kind of infra play. Plus, the managements are getting more aggressive. There is so much of opportunity in the renewable space, and with the kind of capex that I'm seeing on the solar side, on the wind side, that's easily sort of possible. So there are growth. So I would say look at things where things are improving. Their balance sheet, their opportunity is way better than say last 10 years, and their valuation is at least as good as the last 10 years or below.
Right.
So you can filter through such opportunities, and I'm pretty sure those would be pretty good value opportunities.
Sure. And if you were to, tell me about segments that you think are, totally no-go areas today. Of course, we know defense, EMS, and some of these. But tell me from your side, what is priced beyond perfection?
Yeah, I think again the pockets where which fall under high risk, high return category. So some of the PSU sort of defense kind of play. So see, I may say something, but if the high risk probability plays out, right? It the stock will give you even further returns from here, right? But you need to evaluate the risk side of it. So what you think may not happen, because the risk probability may be 60%, but the 40% probability, which is the not risky side, may play out.
Yeah, exactly.
But
What has happened in HAL, for example, I think last quarter or the previous quarter, most of the mutual funds sort of logged out of HAL, and after that it went up, very sharply.
right. So, I mean, see, there are a few things where there is too much talk about that theme. There is, those stocks are illiquid, compared to kind of demand that's there around. So there are a lot of qualitative things that you can look at, whether everyone around knows about that theme, so plus is that theme pretty illiquid relatively, compared to the market cap those are trading at, and how are their valuations compared to, say, the last 5 years or 10-year average? Are they significantly higher? So those three categories, if you look at, so two qualitative and one quantitative, um, stay away from valuations which are, see, valuations which are 20, 30, 40% above average. It's just random movement. But things which are 2x or 3x compared to what they were historically, that means too many things are getting priced in. Plus, if it's illiquid, that means it's easy that even some incremental investors who have got interested, can take up the prices too much. And those things, when they reverse, can be very ferocious. If something goes wrong, if something goes wrong in the next election, because you can never guarantee anything, right? And if something goes wrong in the next election, and if the wrong party comes in, or for that kind of a theme, those things can collapse 50, 60, 70%. Right? So that's what I call as high risk, high return. And then the higher the valuation, even the high returns are capped, because how far can they keep on going up? So there are too many of such things. I mean, there's so much of, look at the SME IPO index. It's gone up 20x in the last 2.5 years, right? It's all illiquidity. There are too many participants who are getting interested in that. So similar, those are extremes, but similar, impact cost is happening even on the sort of some of the PSU themes, where more and more investors, the smart money probably is already out. Now these things can keep on running up, and you will, suck in a lot of last sort of, the new investors who will come in, and they will probably keep on holding this before this collapses. So valuation, illiquidity, and just looking at the qualitative parameter of how well known is this theme, how well is it discussed in social media, on normal media, will give you a lot of those indications. And it is generally FOMO that gets created, and it gets much easily created in a illiquid kind of a space. And some of those spaces are pretty obvious. So if you just look at those three factors, I think you'll get those pockets.
Samit, good you you brought this point on retail participation, because a lot of experts this time sort of believe that this run really belongs to retail. Retail is what has really supported this move. Of course, part of it is the SIP flows, but I'm not only talking about SIP, it's also, direct money that is coming into equities. So historically, if we have seen that as a lead indicator of an impending fall. Retail is the last category to participate. Is it different this time, really? Just to ask an additional question to that, if you see retail participation substantially higher in share, in the quarterly holding pattern, should that be a lead indicator of what is to come in those stocks?
I would not say so, because see, retail participation definitely ballooned post-COVID, right? And then we already have had, and retailers, retail investors do come into the small and mid cap space more than the large cap space. And as you can see, I mean, there are a lot of statistics which are floating around on social media too, regarding the kind of folios which have been created in the small cap space, which are much higher, and that probably is the result of the retail money coming in. But I think a couple of things which I would point out. One is, the in the previous cycle, the kind of margins which are available on the on the exchanges, based on SEBI regulations, were much higher. Today that's been reduced significantly, so there is not too much leverage in the system. Other than, and yes, there are a lot of options, but options can be, you know, can just be for hedge and just for sort of intraday kind of play. So there is not too much of sort of leverage in the system. When you even speak to the brokers, you will see that there is not too much leverage in the system, which can take up the prices. These a lot of retail investors have gone through. Small caps did correct by 33% last year, right? So they have gone through that, and we didn't really see any kind of a panic, right? So doesn't look like they will just run away because of the fear of markets going down. They have seen at least one of that cycle. And thirdly, they have probably just replaced the FIIs. FIIs, when I was looking at the historical ownership of Indian stock market, right, at the highs, I think it was at 21%. Today it's at 18.5%. Right, so that 2.5% difference in today's value is almost 100 billion value. So if they were to come back, and with sort of China more and more getting less attractive, for people, they, and China probably has 3 or 4x of the money, FI money, that India has. So I don't think over a period of time FIs have any option but to come back into the Indian markets. And the more I do speak to some of the FIIs, foreign investor, the endowment funds, and I think the kind of interest that is seen today, I haven't seen in at least my career. So there is definitely a lot of interest. People probably have missed out, but they will have no option but to sort of come back into the market. And that 100 billion, is something that just to come back to the sort of old kind of level. But if they come back, they can come back in much, and the impact that 100 billion will have will be significantly higher than the 100 billion in market cap, right? So I'm not that much worried about I think the retail. I think the retail participants today are much more knowledgeable. They understand the risks. They have gone through the ups and downs in the last, year and a half. And the leverage in the system is not something which I think is scary. The fundamentals of the economy are reasonable. Maybe the retail or the participation which are into the micro cap SME, that's the pocket I'll be really worried about. But I don't think that will have a impact on the main board, index or the overall market. That's a very small sort of manipulated, operated kind of a pocket where people may burn fingers if they are, left hanging there. But I'm not that much worried about the retail participation in the sort of the top 1,000 companies, I would say.
Sure. One last question, Samit, when you talk to companies, managements, what is the sense you're getting? Is our management sounding more optimistic or market sounding more optimistic?
So I think management are cautiously optimistic. They are definitely optimistic, but there is no sort of crazy animal spirit, which you probably saw in 2006, 7. So that's a good thing. They're going for measured capex. So, there are many managements who are going for 2x and 3x kind of a capacity in the next 4 or 5 years without taking any kind of a leverage. So they're not going blindly into it. They're very measured with pretty, frugal kind of an approach through internal accruals. So, but I mean, if you just hear through commentaries of many management, beyond what, say I have spoken to, across the board, good companies do not have enough capacity to even meet demand for the next couple of years. So they are, forced to go for capex. And that generally is a good sign. They are not just going blindly in hope of demand. They know that if they don't build up capex, they will not have enough capacity. A lot of companies' growth is actually less, mainly because they don't have the capacity. I know so many of such companies, and sometimes that fact is also missed out. Is that the companies are not growing that fast, but it's not because of the demand side; it's just because of the supply side, and that's a really good problem to have.
Sure. Thank you so much, Samit. It was wonderful talking to you. As usual, lots of nice insights from you. Thank you so much.
Absolutely my pleasure. Thank you so much for having me, and looking forward to more interactions.
Sure. Thanks.